we're joined by Alan Strauss, Senior Partner and Director of Investor Relations at Crystal Capital Partners. Alan has been with the firm since 2009, helping to lead its investor relations efforts while driving growth across client relations, sales, and marketing initiatives. With a background in both sports administration and broadcast journalism from the University of Miami, Alan brings a unique blend of communication, strategy, and relationship building to the world of alternative investments. We're excited to dive into his perspectives on alts and what's shaping the advisor landscape today. Hi, Alan. Welcome to the Advisor Summit podcast. I'm excited to have you on and kind of dive into a topic that I feel like is, yes, largely known, but also kind of Wild West as well in the terms of alternatives. So really excited to pick your brain and kind of hear your knowledge.
I really appreciate you having me and the opportunity to represent Crystal Capital and obviously talk about something that is near and dear to our heart, both advisors and alternatives.
Yeah, perfect. And the combination of the two and how we can help assist advisors in that journey around them. So, Alan, I found the debate around alternative investments has really grown a lot louder in the past several years. And I know I just got back from Future Proof, and that was one of the key talks at that event this year as well. So, kind of from your kind of large vantage point, how should advisors be thinking about this trend? How should they be thinking about alternatives as a whole? Kind of walk me through just big picture on why they should be thinking about this.
Well, it's interesting that some folks, and I know that you're using what's in the public domain, but the trend of alternatives, right, has pretty much, alternatives are not so alternative anymore. They're pretty mainstream. It's a multi-trillion-dollar industry. It is arguably, in our view, the third leg of the stool when it comes to asset allocation, public equities, public fixed income, and then you've got a bucket of alternatives. As you start to bifurcate what those specific strategies are, I think there's sufficient data to validate the asset class. It is no longer about just having a traditional 60-40, and alternatives have continued to legitimize themselves. It is an institutional asset class where the trend setters of allocation are really the largest, most sophisticated investors we see out there, which are primarily institutions, foundations, endowments, large corporate plans, as well as sovereign wealth. So advisors have to start, if they're not already, I mean, this is a significant asset class that is getting mass adoption, and rightly so. And advisors need to be paying attention to it. And there are many ways that they can skin the cat, if you will.
Yeah, no, we love it. We love a good skin the cat moment. So let's kind of dive into that a bit.
I say that in jest to all of our. I am a dog lover myself, so
I understand.
just need to use the term. That's all.
We're equal cats versus dog lovers here, so it's all good. So, and for those advisors that really feel overwhelmed by the noise and kind of overwhelmed where to start, I mean, you really mentioned also that it's a big third piece of the stool, and I fully agree. I mean, I think it's not a new concept anymore; it's legitimized itself for certain. So what's kind of a starting point for those advisors that want to begin this journey of alternatives?
Well, I think first and foremost, knowledge is power. So you have to have the education. Part of the intimidation factor, both for investors and advisors, is just a lack of familiarity with the asset class.
Sure.
Let's start basically that hedge funds are not, some are less available in terms of information, but this terminology of black box, hedge funds are driven by the skill of a manager, as opposed to the directionality of a market. So they are buying and selling traditional equities and doing it in a very efficient manner. So when you start to take that step back, there is plenty of information that's out there. There are indices for which someone can start to create a baseline or benchmark as to what types of performance ranges there should be. It's important for advisors to start educating themselves on strategies. And then I always like the KISS rule. If you look at alternatives from three main levers, let's just have the ability to initially provide a client capital preservation. If they're looking for fixed income, to be able to do it at a premium to traditional public fixed. And when you're looking at growth, not just be reliant on public markets, which have continuously shrunk over the last 25 years, and where you could argue that there's a very heavy concentration of a particular industry really driving public equity and public market valuations. And then the desire to want to take advantage of innovation, of dynamic new technologies, of traditional businesses, but to again do it in the private markets where there is the potential for significantly more growth than you may find in public markets.
Mm-hmm. And what are some of those, key, you talked a lot about the different types and different ways that they can help advisors. What are their clients, sorry, the benefits they can deliver to their clients. So what are some key benefits that advisors can provide those clients with that, particularly around diversification, risk-adjusted returns?
So, we all learned in grade school, don't put all your eggs in one basket.
Amen.
Alternatives, if we're all looking at it from the three-legged stool, again, public equity, public fixed income, and then the basket of alternatives. It's important to also be able to diversify within alternatives. And alternatives have historically had that as a major benefit. When you're looking at hedge funds, it's the ability to really diversify across multiple industries and segments, parts of the capital stack. It's to bring lower volatility strategies to a portfolio, or really just bring a low vol investment into the portfolio. So to bring shock absorbers. So those are measurable benefits. Low correlation. When you look at statistical information, which it's plenty is out there. So when you talk about an advisor having the tools to be able to measure things, that's an important starting point. The educational information can be found, self-serving, but groups like Crystal Capital Partners, that's what we've been doing for the last 15 years. Is really servicing advisors so that they have the access to the information, the ability to provide educational information to themselves and their clients, and the ability to make things fairly simple in what is otherwise a very inefficient world, let's say, and that has significant barriers to entry, whether it's minimums, whether it's portfolio construction, whether it's the access to the data. So beyond low correlation and low vol and ultimately diversification, it's some of the other things where if you go back to those three main levers that I want to pull, if a client's looking for income, you look at what the rates of SOFR are doing. And in a rising rate environment, which we've been in, maybe that
Right.
client, if they're the best client at the bank, they're looking at the prime rate. And in today's rate, somewhere between 4% and 6% possibly. But when you look at private credit and its ability to generate returns, it has been able to do that in multiple market cycles and at a premium to traditional fixed and avoid the
Mhm.
pitfalls of what would be a detriment to private credit yield, which would be defaults. And then in the private markets, like we said, if we all look back at what the S&P had as its top 20 companies only 20 years ago, I mean, Ray Dalio pointed this out in a recent letter and talked about, Ray Dalio from Bridgewater, and he talked about, in a public letter that was out there and simply talked about, make sure you're paying attention to the changing dynamics of the markets and economic cycles. The top 20 companies in today's S&P 500 are not the same as they were 25 years ago.
Right.
So
Right.
the ability to try to invest in some of what will be future generational technology or evolution or the disruption of certain traditional businesses, which may disruption meaning a very practical brick lane company or a trash collection company starts to have technology to
Mhm.
enhance some of its practices. Well, how do investors take advantage of that? It's not necessarily happening in the public markets. It's going to happen in private markets. So those are real benefits that advisors can start to pay attention to bring these types of strategies to their clients.
I feel like that is really a leeway also to Crystal Capital as a whole, because I feel like a lot of advisors have those big barriers like cost, like lack of understanding, lack of knowledge, and all of that, like that you mentioned. So how does Crystal Capital kind of stay ahead of the curve? How are they continually, you mentioned technology as well as education. What are kind of the things that you all provide to advisors that would alleviate the advisor having to do it themselves?
That's a great question. Thank you, Molly.
Mhm.
We are an RIA first, so we want to
Mhm.
eliminate conflicts of interest. We're not a distribution platform in that traditional sense. Managers are not coming to us and saying, hey, we know that you work with advisors and it'd be great if you help to distribute a fund. It's quite the opposite, right? We are the largest allocators within our own platform, the partners of Crystal, myself included as one of the partners for the
Sure.
last 15 years at the firm. And so we've created the ability to invest in the managers and then come to advisors who are also the fiduciary to their client. And they have many investors and clients with whom they need to satisfy and meet their alternative investment objectives. So Crystal has an entire user interface that brings to that advisor a window into this world of alternatives. We work only with established funds. That doesn't mean we have a bias against the smaller or the startup fund manager, but it's a
Good.
matter of providing significant business risk because the
Yeah.
investment risk is mitigated through diversification. So it's to give the advisor tools for monitoring funds, becoming aware of who those funds are, being able to digest all of the qualitative and quantitative information of those managers, compare them to each other, compare them to industry benchmarks, compare them to non-alternative investments, right? So mutual
Right.
fund to a hedge fund,
Right.
and what would be the efficiency of one? And the same thing in private markets. Be able to understand what managers have done vintage over vintage, be able to understand the types of companies that they've been buying, and understand more about their playbook. And by the way, these are firms and funds that have had significant barrier to entry. Their minimums are in the multiples of millions, but with Crystal, advisors, as long as they have a qualified purchaser client, which could be an individual or an institution, now have the ability to do this at substantially lower minimums, as long as the client's a QP, and be able to diversify across an entire grouping of private market funds, and be able to do that with consistency, quarter over quarter, year over year, whatever the
Yep.
objectives are as they evolve for the client, and to be able to do the same thing with hedge fund strategies as well. And that's really how, where have alternatives really gained the proliferation, is because there's been success, but the recognition that alternatives have gotten, not over the last 5 years and not since the global financial crisis, but really when you look at the industry, I mean, it's over 30 years of developing a track record among different managers, a grouping of managers
Right.
we really refer to as those institutional funds, and for advisors to now be able to take advantage of that and bring those types of opportunities to their clients. It's what institutional allocators, we said it at the outset, Molly, that's who many consider the trend setters. They've been
Right.
doing that for decades. And now it's not just for the largest individual family, but for a high net worth client that wants to have this exposure. And that's how we help advisors do that.
Right. I feel like it's like you said, alternatives are not a new concept. It is maybe the hot topic now, but they've been around for decades, and it's really took that time to build and grow, and now is allowing a much larger subset of group of people to, invest and take advantage of those. And what a blessing to be in this era, in this time where advisors can give their clients really that fiduciary responsibility and increase their portfolio even a little bit more than what they've currently been doing. I obviously am pro Crystal Capital Partners helping advisors, but maybe for some advisors that potentially aren't ready to partner, what are kind of some of the first simple practical steps that they can take if they want to introduce alternatives to their practice?
Well, I think in this day, you need a platform partner. So
Mm-hmm.
Crystal's here as a resource. Obviously, we can't work with everyone in the world, and
Right.
others want to. But I think that it is important, as the more I see advisors, to be able to avoid pitfalls and to really do what advisors do best, which is to manage their clients, and not
Right.
necessarily the advisor who has their name on the shingle, you know what I mean, or who's hung their shingle and has their name on the door. That person is also going to wear multiple hats of due diligence and of the
Yes.
administrative processes, the meeting capital calls or rebalancing portfolios, right? There are certain other parts of the investment journey that really take the heavy lifting off and have a solution that's turnkey and that's scalable, like Crystal is. But definitely avoid a lot of the pitfalls of just trying to identify one fund, and then having the speed of diligence to be able to really identify 4 or 5 or 6 funds that are all open, that are all taking capital, and for you to be able to get your clients subscribed in time.
Mm-hmm.
Those are some of the real issues that an advisor will have. If we don't diligence enough funds on time, then we don't have a rich enough offering, and then we're not really giving the client a diversified exposure. So
Right.
when you're working with partners, that is their scope of work and that's what they're focused on, it allows for the advisor's job to be scaled, more efficient, and certainly become more profitable with their time.
Right. And I feel like what you said, time is everything, time is energy, and time is money. And the speed that you can get that client into that is so important, and you can't lack in any capacity or in any timeliness. So how do you recommend advisors communicating the value of alternatives to clients? Because again, advisors are inundated in this world. They know about it. They've heard about it for a long time. But a lot of times I think about like my parents, my dad's a dairy farmer. He's not in the financial space at all. So I think he would think alternatives, what is this? So how do you recommend
For him,
communicating
alternatives
that?
are oat milk and any nut milk, right?
Exactly, which is a whole other battle because it's not actually milk, it's from nuts, and it should be called nut juice, and it's not correct by any means. So, but that I will talk about that later. So, but yeah, just, I mean, how do you feel like you can explain that to clients without making it overly complex or intimidating for them?
I think thought leadership is important. So advisors, when they're working with partners, for example, when advisors work with us, we provide a lot of content and educational information, whether it's about different themes or industries. So don't be afraid to have those conversations with clients about wanting to take advantage of artificial intelligence. Well, how do we do that? Or software or additional sources of generating income. But for an advisor, education becomes critical and providing that information to clients. But hedge funds, as we said at the outset, as an example, start with the simplest concept that you can for the investor or for yourself. I mean, listen, it's not to insult the intelligence of anyone who's listening to this program or who's obviously in this industry. They have training. These are professionals. But for whatever reason, the intimidation factor, go back to what I said a few moments ago. Hedge funds are solicited. Folks, the word is, people want to invest in hedge funds for their ability to not be directional. In other words, or to be directional. The skill of the manager is what drives. So their ability to be both long and short. They're buying public equities. The information of where they invest is available every quarter through the SEC's 13F filings. And you'll find that there are plenty of very notable companies that folks see that are public companies. So it's like hedge funds are doing something that's just so irrational. What they're doing it is very efficiently. And when you're talking about private equity or private credit, it's simply making loans or acquiring companies that are not yet available in the public market. And those are giving a client exposure to very different segments of the economic environment.
Right. And I think that is the key. It's giving different exposure. It's diversifying in a better, and like you said, low vol. I mean, it's hugely complementary to what they're doing already. So I don't see why anyone wouldn't want to invest and dive into here.
Well, and Molly, the importance as you take it, like you're saying, how do you introduce it? If you can get past the qualitative part with an investor, which is to at least introduce these concepts, and then to be able to provide them information that quantifies the benefits, right? This is going to be a part of the overall portfolio. This is one more component of diversifying, and we feel that it should itself be also very diversified. You don't say, I want to invest in artificial intelligence and only invest in one manager that's going to target that sector. You want to find 3 or 4 experts that are going to do it today. And then 6 or 9 months down the road, as new technologies become available, it's the potential to be able to invest in other managers that are also doing that, or pivot away from, I don't want early stage investing. What I want to do is something more mature. I need income. And so the ability to be able to be so dynamic is what advisors do not seem to have today when it comes to alternatives. And that really is something that is important for an advisor, to make sure that they are as dynamic in the alternative investment offering and in the alternative investment world that they're navigating in as they've been in traditional investments, as they've been able to be in tax planning, as they've been able to do in estate planning, right? So many of the real value adds that advisors bring, alternatives is another place where they need to be as proficient.
Right. Do you think maybe like in 5 to 10 years in the future that you would see the role of alternatives being very commonplace, that it would be just another investment group that nobody really thinks differently of?
I mean, frankly, we think it's there today. We're seeing legislation that's only going to allow it to be more massively adopted, right? We'll see what comes down the pike with larger retirement plans and things like that. But, alternatives, again, something only gets this level of attention because it has had the ability to demonstrate its resilience in multiple market cycles. So if that's the practical approach, which is to find managers that have delivered consistently through multiple market cycles, it's about finding those types of managers. And those managers, there are not tens of thousands of them out there. So again, it goes back to, for an advisor to bring these strategies, it's very prevalent. It's now being marketed to not just alternative accredited investors and qualified purchasers, but you're starting to see many retail channels, rightly so, have exposure to alternatives. But it becomes that much more important for advisors, to find asset managers on a consistent basis, as opposed to asset gatherers, And that goes back to why it's important to find partners that have a great deal of expertise in this ecosystem.
Mm-hmm. You mentioned some of the legislation that's been going on that is upcoming. For any advisors that are kind of unaware of what's happening, can you talk a little bit about that, just some of the updates that are going on?
Well, I was just alluding to one of the biggest pieces of legislation which we see coming down the pike, and there's a lot yet to be evolved. But the fact that the current administration is going to allow for 401ks to invest in private equity in particular. And that is a very important dynamic because it will expand the available investment category of alternatives that we're talking to many more investors. But there have to be important guardrails in place. And then the conversation of, are we comparing apples to apples, right? So is the same PE product that may end up in, or a PE investment, private equity investment that ends up in a 401k plan, the same as the primary commitment that Molly Pierce made in her IRA, or that Molly Pierce's trust just made into a specific manager. Yeah. So the ability for investors to really get information on that and understand what the rules of engagement are, for lack of a better word.
Right. When do you see that potentially coming to fruition, if you had to guess? I know it's anything in legislation is a bit timely. So do you see that? I mean, you see it coming down the pike, but when?
That's a great question, Molly. And despite the fact that her name is Crystal Capital, I don't have the ball to be when that happens. Listen, what we've seen in the last 30 years has already been game changing, right? When we started our firm back in 1994 and we were investing in multi-manager portfolios and creating multi-manager portfolios for investors, the dynamic and where the paradigm has shifted today in managers that back then were really part of a cottage club industry. And today, here we are talking about, the continuous growth of alternative investments. So that's been amazing to see and to kind of have a front row seat at seeing it over the last 15 to 20 years myself personally in the industry. So I think those dynamics we're on the precipice of it, without me, putting in an over-under betting line on it.
Yeah, I know it's maybe not the right thing to gamble on, but I do think it'll be a happy day for certain. There's just so much opportunity should that come to fruition, which, we're all hoping. So what do you think will separate advisors who really thrive in this space versus those that lag behind? So if an advisor is really against adopting alternatives, how do you see that really hurting their career?
I don't know that it's hurtful to their career. I think ultimately folks are doing a service component to a client, acting as really a financial quarterback, acting as a behavioral scientist from time to time, or a behavioral manager from time to time, to try to remove the emotion from decisions that should be pretty objectively done. It's a matter of choice. There are going to be clients that don't want to talk about alternatives. I certainly think that advisors who are now starting to pay attention to younger clientele, younger investors are certainly, now they may not be qualified yet, but as investors do navigate through the chain of wealth, younger generations are going to be more interested in consuming these types of investment opportunities. So it's a matter of personal preference. Do we see businesses having measurable benefit, advisory businesses having measurable benefit from offering alternatives? I can speak to that and say unquestionably yes, from many standpoints. The ability to be able to find clients or cater to clients that they had not originally been able to, because those clients had seen their services and their offerings as maybe not sophisticated enough for them. So advisors now being able to expand wallet share, being able to find new client types. Also the ability for an advisor's revenue, the same way the volatility of an investor's portfolio can be made to be a little more consistent or protected or mitigated. Think of the consistency that now comes from the revenue of an advisor who offers alternatives as part of their portfolio allocation or their entire asset allocation, right? Because the pricing of these assets are monthly or quarterly. It also smooths the revenue spikes that an advisor may have if they only offer public securities or public equities as asset allocation tools.
Right.
So those are important criteria that we see.
Yeah. No, I love it. And I think that this is a hugely insightful piece for any advisor that's looking to get into alternatives. There's obviously partners that you can work with. If anybody wants to get in touch with you, Alan, what's the best way to do that? Is it via your website? Is it via email? What's the best way to get in touch?
Well, in the modern technological world, we have a handful of ways that people can find us. Certainly, people can find
Yeah,
me on LinkedIn, and we could have a conversation and strike it up
perfect.
there. Um, Also, folks can go right on our website and go to crystalcapitalpartners.com or just search Crystal Capital Partners. They can see plenty of information there and then request to either sign up to access more or simply to have a conversation.
Yeah, love it. And I
And
love that
if
you're giving
it comes up
knowledge.
on screen, they can also send me an email directly. My email is just A Strauss, like my last name on screen, at Crystal Funds or at crystalcapitalpartners.com.
Perfect. We can also link it in the show notes, so that's helpful. So, kind of last question of the Advisor Summit is where are you trekking today, either personally or professionally? Any big goals as we end the year or potentially for
Lots of goals.
2026 now
Lots
that
of
we're getting
goals.
closer?
Listen, from a business standpoint, we started with a lot less than we are today. We're a $1.3 billion shop. We've obviously been doing this for a long time, but our platform, as we're discussing today, really launched in 2010. Today, there are
Okay.
over 500 portfolios. We work with over 300 advisory firms nationwide. So that's thousands of
Amazing.
advisors that we're working with. And while no one ever needs a pat on the back, we are very happy with the continued growth and the evolution of Crystal,
Yeah.
and we will continue at it, right? As partners here, like I said, we're the largest investors, so we're not going anywhere.
Yeah.
And personally, I mean, listen, I have 3 kids, twins who are almost 10, and a middle schooler on the cusp
Oh,
of high school.
amazing.
So there's a lot of trekking still in my journey, you know?
Yeah. Yeah, that's amazing. Twins are so fun. I'm a twin myself, so it'll if they're not friends already, just wait. It'll get a little bit better as they peak a little bit closer to those high
You have
school
a twin
years.
sister, you have a twin brother.
Twin brother, so that makes a difference as well, I
Same
feel like.
dynamic, same dynamic. So your
Yeah,
brother
yeah.
was already trained for marriage from the womb. The same way we
Oh,
say that my son
100%.
is
Yeah.
trained for marriage once he gets there.
Yeah, yeah, he is. And he also, well, I'm one of 6 and there's 5 girls and 1 boy. So he was certainly trained for marriage from the day he entered this world. So we
Wow. I'm
taught
sure
him.
there was a lot of you mentioned your dad was a dairy farmer, so I'm sure there was
Yeah,
a lot of chores on the farm if that was the
there
case
was.
with a
Kept
brood
us
of
in line.
6.
Yep, kept us in line for certain. So, Alan, thank you so much for joining us. I'm excited to kind of watch Crystal Capital Partners continue to evolve and grow and just solidify their place in this field. But thank you for sharing your knowledge. We appreciate it.
Molly, I say the same for you at Advisor Summit. Thank you for the time. Really appreciate you having me on the show today.